Budgeted income statements. Now, these used to be quite high tariff questions, so high mark questions, 15-mark questions on the old AS papers. And they've come up in recent years, but not as big as those AS questions. So I would say have a look at those, just purely because they could decide to go with that. And I'm going through the layout, not a full one. So I've got this as the steps you should look for, and the second slide just goes through a couple calculations with my normal scruffy writing from the whiteboard. But budgeted income statements have come up a couple times in recent years, but not a big 14 marker, and it's definitely something they could do, because one of the big parts of paper 2 is budgets. And so if we looked at a budgeted income statement, it brings together a lot of different skills. So it would make sense for them to do it. And so what it does, it combines a lot of the calculations you've already covered. So all the other budgets that you understand and can appreciate, you bring all together in one go, which is why this is a useful one. So the budgeted financial statements, so that's in the budgeted income statement and the budget statement of financial position, are often called the master budgets. So I was going to say flex budgets there. That's something else I want to chat about at one point. But the master budget, so it's bringing together all the budgets into a set of financial statements. And so you've just got to be logical with one of these questions. I know I say it all the time, but you do. You need to start with the top of an income statement, which is sales. And so you've got to calculate budgeted sales. Now, to do that, you need to break it down into two components. And so this is where people are often not particularly happy, is that you look into units, but you've just got to think about management accounts in a slightly different way to financial, because financial is given a revenue figure and you would adjust it. So you would have budgeted units sold, so you might be told a percentage increase or decrease in the amount of units sold. There'll be marks attached to getting this correct. You've got to look at the budgeted selling price, so you might need to look at last year's revenue divided by last year's units to get that. There's quite often a mark for doing that. You've also got to factor in a potential split year. So you might have a certain amount of units sold in the first 6 months, or in the second 6 months, or the first 3 months, second 9 months. Be very, very clear in your workings and how you get to that budgeted revenue figure. And finally, the budgeted selling price might need to be increased or decreased according to a change in selling price. Any percentage changes nearly always will attach a mark. So if you're looking at a question, even if you do the percentage changes, you're going to pick up some method marks. Something else to consider once you've worked out the budgeted revenue is carriage outwards. And so when we're looking at carriage outwards, well, what we're saying is it's an expense. We know, well, hopefully you know it's an expense. You've got carriage inwards, which is within cost of sales, and then we've got carriage outwards, which is within expenses. So if you're told there's a carriage cost per unit, you need to think, oh, wait a minute, I've just worked out the units sold, I know the carriage outwards, or I've got to adjust the carriage outwards and multiply those together to get a carriage outwards expense. It's a nice little extra thing they throw in there. When you've done the sales, you then need to look at the purchases and your cost of sales section. And part of that is to work out the amount of units you need to produce. So I've popped in there purchases. Now, purchases in that context would be the production budget. And so what we've got here is a slightly different calculation to what you're probably used to, because it's closing inventory plus sales less opening inventory. Now, the reason it's that way is because we're looking at how much we need to produce. We're not looking at producing the financial statements at this stage. So we need to produce enough for closing inventory, enough for sales, and we don't need to produce opening inventory because we've already got it. So if you think if closing inventory is going up, we're going to produce more than the amount we sell. So this links into production budgets. Once we've got that purchase figure, we're going to multiply it by that budgeted purchase cost per unit. Now, the purchase cost per unit you might need to calculate from last year. So again, you look at last year's purchases divided by units, and there might be a percentage increase or decrease. So be methodical, step by step. So we've got revenue, now we're looking at cost of sales. When we're looking at that, also if they say delivery cost, we'd have to multiply the amount of units that we actually produce and purchase by the cost of delivery per unit, and carriage inwards goes in cost of sales. So they could do that to you. Closing inventory is often the highest amount of marks on one of these questions. It's like the top half, the trading account, which I have to say, if you're doing a budgeted income statement, if they just asked you to do the trading account, hopefully you know this, but trading account goes to gross profit, because it used to be, and for me it still should be, the income statement was called the trading profit and loss account. So the top half trading, how much gross profit we make, the second half expenses to work out the overall amount of profit and loss that we generate. The closing inventory, we can calculate the units. We can go opening inventory, So the amount we had at the beginning plus purchases, the amount that we need to produce, less sales, and that will tell us the amount of units that we would have left at the end of the year. When we know the units, we've got to multiply it by whatever they tell you. So they'll usually tell you that closing inventory is valued at purchase cost. So that will be the new purchase cost you've calculated. But remember that delivery cost can be included within the inventory valuation. So you should add delivery. That'll be an extra mark as well. So the purchase plus delivery multiplied by the amount of units. Occasionally, instead of that, the closing inventory is a percentage. So they'll go, closing inventory will go up or down by a certain percentage based on last year's closing inventory in units. So you will look at that units, and it's quite often it's a strange percentage, like 12.6%. And so therefore you would have to make sure you take off 12.6% of those units. So what, 0.874 times the amount of units from last year, and then multiply it by the purchase cost per unit. Then it will just be with expenses, and so it should be okay. You've just got to read it. Read these questions carefully. So you might have a split year with wages, or you might have a pay rise at one point, or you might have maintenance increases, whatever it might be. There'll be a couple marks for expenses, and then it's profit for the year. Very much just a step-by-step process. And the units, just make sure you can look at the production, make sure you can do the closing inventory and the sales. Most of the marks are there. So we'll look at a scenario. If I can get my slide to go forward, which it doesn't want to. I'm going to stop and come back. Okay, well that wasn't as seamless as I'd like it to be, but I don't know how that works on the video. If you just get and I'm back on, or if it just goes straight on. I'm going to stop waffling. Anyway, so budgeted income statement, just a couple calculations. And so we've got last year's performance. This was a pizza company. Yes, AI did make this up for me. So last year we sold £960,000 worth of pizza, and we sold 64,000 of them. We project, now it won't be laid out as cleanly as this, but this type of information will be there. So we project the sales volume is going to increase by 25%. So you can see at the top there, it says sales, 64,000 times 1.25, that will increase it to 80,000 pizzas. So we're projecting that we're going to sell 80,000 pizzas. Our selling price is going to be £1 cheaper than last year. Well, that'll be why we're selling more then. So we have to go back. So 960,000 divided by 64,000 pizzas. So we sold them for £15 last year. So we think this year we're going to sell them for £14. So our budgeted revenue would be £1,120,000. Now that wouldn't be a huge amount of marks, but it'll be a few. What we've also got to factor in then, inventory. Well, they have told you the opening and closing inventory. So opening inventory would be 1,200 pizzas, closing inventory would be 2,000. So from that, you should hopefully see straight away, well, we're looking to produce 800 more pizzas to have the closing inventory, and therefore we will produce 800 more than our sales of 80,000. So we will produce 80,800 pizzas, or I've got the calculation there. So sales 80,000, take away the opening of 1,200 plus the closing of 2,000. Now, they've told you below that material cost is £5. So each pizza costs £5 in materials. So our purchases cost, we will times 80,800 by 5, would be 404,000. We would also have, because it tells you carriage inwards is 50p, so we will go 50p times the 80,800. We'll have a carriage inwards cost of 40,400, and the closing inventory has to be valued at £5.50, because like we said, it includes the delivery cost. So our closing inventory would have been valued at £11,000. Carriage out, if I haven't said so already, will times the 80,000 pizzas by 80p, and you would have a expense figure of 64,000. All of that might be a little bit more of an adjustment, but all of that would be a reasonable amount of marks in a question. Why is a budget income statement useful? Could have a 6 marker that links to it. Helps us to identify whether we're going to be profitable in the future. If not, we can look at making adjustments now before it becomes a problem, rather than going, oh, suddenly we're not making a profit. We can actually understand there's a possible risk. We can then use that to set targets, because if we are going to make a profit, we can say, look, we're only going to make a profit if you can achieve this, if you can keep wages within this realm, if we can sell this much, and we can keep an eye on it. So that should help us to get investors, because they can see how we're performing. However, Income statements nothing to do with cash flow. Businesses close because they run out of cash. There's lots of estimates, such as depreciation, such as the amount we sell, that could be wrong. And external factors means our actual performance could be very different. I mean, we look at political factors, we look at competitive factors. There's so many different things that could change it. But budgeted income statements, really good little question. You just got to be step by step.